So back in March 2023, Silicon Valley Bank, I mean, one of the biggest banks in the US, just poof, it imploded. It really seemed to happen in the blink of an eye. But here's the thing. What if it wasn't some bolt from the blue? What if all the red flags were waving right there in public for anyone to see? I mean, that's the big question, right? The one that absolutely rocked the financial world. How does an institution that massive, the bank for the entire tech industry, just evaporate over a single weekend? It's honestly a terrifying thought. Well, the short answer is, it doesn't. SVB's collapse was anything but sudden. It was more like a slow-motion train wreck. So today, we're going to put on our detective hats and follow the breadcrumbs. Because the clues, they were hiding in plain sight all along. All right, so we've broken this down into 4 main buckets of red flags. First up, the huge gambles SVB took. We're calling those the big bets. Then we'll dig into their shaky customer base, their fragile foundations. After that, we'll see how their profits were basically crumbling away in eroding earnings, and we'll cap it off with some seriously bad decisions and strategic missteps. Finally, we'll put it all together to see the writing on the wall. Okay, let's dive into that first bucket, the big bets. This is where SVB basically stopped acting like a normal bank and turned into something more like a giant, leveraged hedge fund that made one single, absolutely catastrophic bet on where interest rates were headed. Okay, to get this, we gotta wrap our heads around something called unrealized losses. Think of it like this. You buy a house for, say, 500 grand. A year later, the market tanks and now it's only worth 400 grand. You've got a $100,000 unrealized loss. You haven't actually lost the money yet because you haven't sold the house. For banks, their bonds are like these houses. And when the Fed started jacking up interest rates, the value of all their old, low-rate bonds just plummeted. And this is where a little bit of accounting magic, or maybe mischief, comes in. Banks can classify their bonds in a couple of ways. If it's available for sale, or AFS, they have to mark those losses down on their books. It hurts, but it's honest. But if they classify them as held to maturity, or HTM, they can basically just ignore the losses. They just say, hey, we're going to hold this thing forever, so the current price doesn't matter. It's a pretty convenient way to hide a huge problem. So what did SVB do with this little accounting trick? You have to remember, during the pandemic, tech was booming. SVB was just flooded with cash from all these startups. So they went on a massive shopping spree, plowing over $100 billion into long-term bonds, right when interest rates were at zero and bond prices were at an all-time high. I mean, you couldn't pick a worse time to make that bet. So naturally, when interest rates started to skyrocket, the value of those bonds cratered. And this is where SVB made its fateful choice. Instead of facing the music, they hid the problem. They started aggressively shoving their bonds into that held-to-maturity bucket. Look at this chart. Over 60% of their assets were classified this way. That's way, way more than their competitors. They were literally using an accounting rule to paper over a disaster. Okay, so that's the asset side of the story. Now, let's flip over to bucket number 2 and look at the other side of the ledger. Because a bank is only as solid as its depositors. And SVB's foundation, it was basically built on quicksand. You see, SVB wasn't like your neighborhood bank with millions of regular people. Their customers were a tiny, super concentrated group of tech startups and venture capitalists in Silicon Valley. These people all know each other. They're on the same Slack channels, the same group text. This isn't a crowd, it's a network. And in a network, panic doesn't just spread, it goes viral, instantly. And here is the absolute kicker. A mind-blowing 94% of the deposits at SVB were uninsured. They were way over that $250,000 FDIC limit. These aren't just regular folks. These are sophisticated CFOs and VCs. They had zero reason to stick around at the first whiff of trouble. It was their company's payroll, their investors' money on the line. Of course they were going to run. And don't think for a second this was just a theoretical risk. Just look at a similar bank, First Republic. They lost $102 billion in deposits in a single quarter. A modern bank run isn't people lining up around the block anymore. It's a few taps on a phone, a few frantic text messages. Billions can just vanish in a matter of hours. This was the loaded gun sitting on the table the entire time. So let's recap where we are. We've got a massive, hidden loss on the asset side and a super nervous, concentrated group of depositors on the liability side. A recipe for disaster, right? But what about the actual day-to-day business of being a bank? Well, that brings us to bucket number 3. The core business was rotting from the inside. So this chart here shows something called net interest margin, or NIM. It's a fancy term, but it's basically the core profit a bank makes on its loans. And for a decade, SVB's margin was worse than its peers, and it was trending down. What does that tell you? It tells you they were having to buy their business, offering better deals on loans and deposits just to keep up. That's not a sign of a strong, healthy company. It's a sign of a company that's struggling to compete. Now, if you're an investor, one of the key metrics you look at is return on equity, or ROE. And for years, SVB was a Wall Street darling, a real star performer. But then, look what happened in late 2021. This is way before the crash. Its ROE just fell off a cliff, from the high 20s all the way down to single digits. The party was over. The whole high-growth story that propped up its stock price was officially dead. There's a quote from one of the reports we looked at that just nails it perfectly. It says SVB was, quote, sucking wind. Not just in one area, but across so many parts of its business that its stock was basically destined to collapse. And it really was everywhere you looked. As interest rates went up, all their other little moneymakers started to dry up. The profits they made selling securities, gone. The value of the equity warrants they took from startups, crushed. Their investment banking division that was supposed to be this big growth engine, totally stagnant. The whole machine was grinding to a halt. Which brings us to our fourth and final bucket. Because these numbers, these bad bets, they don't just happen. They're the result of decisions made by people. This is the human element, a story of disastrous choices by management and a shocking lack of oversight from the board. I mean, the list of mistakes is just stunning. They grew by 271% in just 3 years. That's way too fast for any company to handle its risks properly. And then, and this is the part I still can't believe, as interest rates started to climb, they got rid of their interest rate hedges, the very things designed to protect them. It's like throwing away your umbrella just as the storm clouds are rolling in. All while federal regulators were literally sending them warnings, which they apparently ignored. So you have to ask, where was the board of directors in all this? Who was supposed to be the adult in the room? Well, this table says it all. Compared to similar banks, SVB had zero, let me say that again, zero, independent directors with high-level, senior executive banking experience. There was nobody in a position of power who had the background to see the giant iceberg right in front of the ship. So let's pull it all together now. This wasn't some random, unpredictable event. It wasn't a black swan. The writing wasn't just on the wall, it was in giant flashing neon letters. You had the 4 key ingredients for a total collapse. 1, reckless bets on their balance sheet, hidden with accounting tricks. 2, a fragile, jumpy depositor base that was guaranteed to run. 3, a core business whose earnings were collapsing. And 4, a leadership team that was asleep at the wheel, if not steering them directly into the storm. You know, at the end of the day, the SVB story is a classic cautionary tale. The story they told everyone, that they were this cool, innovative bank for the tech world, was just so much more compelling than the ugly numbers buried in their public reports. But hype can't fix a broken balance sheet, and a good narrative doesn't pay the bills when the fundamentals are completely shot. And here's the most chilling part of all. Every single red flag we talked about today was right there, in public filings, for more than a year. The data was there for anyone who bothered to look. And that leaves us with the real question, the one that matters way beyond just this one bank. It's not just about what went wrong at SVB. It's about what other time bombs are out there, ticking away, hiding in plain sight. The real question is, who's not looking now?